Brooke asks, do you recommend deducting the asset the first year we have it or over time? That's a good question. Like a good example is this MacBook I'm recording on. I bought it last year, and I would have the option to deduct all of it in that year or depreciate it over time. I chose all in that year, but like, what advice would you give to Brooke?
So it depends. So usually about 2,500, anything over 2,500, they ask for you to do what they call depreciate or do it over time, as Brooks said. But it also depends because there's other little loopholes. Like there's certain like assets you can write off and you can take it all in the first year. It really just depends. I would say 9 times out of 10, I would take it up front. But if we're talking about, let's say, a rental property, because I know a lot of people that are in the gig economy ultimately want to build up more passive income. And I know real estate and rental income is a hotspot for many of them. You're going to take the expense over the life of the property or over the life of time. And that's usually for a rental property, is usually 27.5 years. So it really depends. Some years you might know you're going to have a higher tax bill than others. Some years, you might have a super low tax bill. So the year, let's say like this year, you got a super low tax bill. But next year, which is actually right now, right, because we're in the 2020 tax year, but it's year 2021. So, if you know that you've had a massive increase in business in 2021 and you expect and project it to continue to be massive and grow, you might say, you know what, I'm going to stretch out this expense because I know I needed to reduce my income for next year. For this year, right? But for next tax year. So you might say strategically, I want to push it out. But again, it all depends. There are no one size fit all scenarios. There's no cookie cutter solutions.
Right. So that's gonna depend on a case by case basis.
Absolutely.
Yeah.
For Brooke, though, because we all know Brooke is like a social media guru, more than likely it would probably be best for her to take the expenses in the first year. More than likely. But again, sometimes it may vary.
All right. And DB, I know about the gas and such. It's about paying for the car itself. I think we already addressed that. Todd, whether you rent or make payments, you be able to put on taxes, but they will answer it. I'm not sure what you mean, Todd. Are you if you could elaborate on that, we could do it. Brooke has another question. So, question: my business has been open 3 years and always do self-employed taxes, but my S corp took effect in October. So, do I change for this year?
I would need to see if your S corp went back to January of 2020, or if it was just starting. Like, I need to see the documentation because Brooke is definitely capable, but I always hesitate to give answers like that because sometimes people will read something and it's not quite right. But more than likely, Brooke, just using your scenario, you shouldn't have any self-employment tax in 2020. However, since you are now S corp, you are required to pay yourself a market rate salary. So hopefully you paid yourself as an employee, right? So the IRS knows that people are trying to get out of paying the self-employment tax. That's why most of these social media memes out here that say former S corp are trash, like they're absolutely trash, because the IRS knows you're trying to get out of paying the self-employment tax, which is like 15.3%. However, when you're an employee, you're paying into FICA and Medicare and all that. That's in effect what SE or self-employment tax covers. The difference is when you're an S corp, you get to control more of it, right? Because what's market rate, right? I mean, it's kind of wide, right? You could have I have clients who have $1 million in, let's say, profit, and many of them may only pay themselves, let's say, $100,000 in salary. So they put themselves on payroll for $100,000, but that not $100,000 is then going to be taxed as a distribution and not as self-employment tax, not as a 9-to-5 payroll employee either. So there are some loopholes, but again, you got to do it right, and there is no free lunch.